How's it going, everybody? Welcome back to Astroverse. Today we're going to be doing a recap of last week and trade ideas for the up and coming week. The federal funds rate remained unchanged at 5.5% in line with expectations and the previous rate. The Feds released a statement indicating solid economic activity, although job gains had slowed in recent months. Inflation remained elevated, and the committee expressed concerns about tighter credit conditions and their potential impact on economic activity. The Federal Reserve decided to maintain the interest rate paid on reserve balances at 5.4%, along with various other directives to maintain the federal funds rate within a specific target range. In other news, the USD employment claims came in better than expected at 201,000, while the USD flash manufacturing PMI and flash services PMI also beat expectations. Market expectations were that dots would show upward movements in interest rates for 2024 and 2025, with a particular focus on next year. The shift was considered hawkish as it indicated just a 50 basis point rate cut for 2024. While the market was somewhat prepared for the shift, it may try to interpret this information more dovish in the near term. The official statement made no changes to interest rates and upgraded the characterization of economic growth from moderate to solid. It acknowledged a slowdown in job growth, but was otherwise largely unchanged. So in the dot plot, 2023, the projected rate remained at 5.625%. In 2024, the projected rate increased at 5.125% from the previous 4.625%. In 2025, the projected rate increased to 3.875% from the previous 3.375%. And in 2026, the projected rate is at 2.875%. The long-term projected rate remained at 2.5%. The Fed's forecast for the next few years, we have to see the next few CPI and PCE and also GDP. So what they are to get a proper idea on the direction that the market would take, as shown on the screen. The meeting participants provided projections for GDP growth, unemployment, and inflation. These projections are based on their assessment of appropriate monetary policy. There was a considerable uncertainty associated with these projections. Market anticipated the Feds to keep the rates the same, so Monday and Tuesday pullbacks occurred, hence the saying buy the rumor, sell the news. We marked up longs from 1930 and above, and on Wednesday gold initially pushed up to around 1947, and then FOMC caused a bear run, bottoming out at 1915 and then pulling up to 1925 to end the week. On the dollar index, we ranged from the lows 104.6 to the highs at 105.8, closing at 105.582. And the US 30 index reached 34,800 but dropped to 34,000 by the week's end. So we anticipated that as long as Dixie stayed above 105.5 and gold remained below 1930, there could be bearish pressure on gold and bullish sentiment for the dollar, and geopolitical tensions remained relatively subdued. So what to expect for this week? So we have CB consumer confidence on Tuesday at 10 a.m. Eastern time. The forecast is 105.5, slightly lower than the previous of 106.1. So a drop in consumer confidence might signal concerns about the economy, potentially impacting the dollar. So on Thursday at 8:30 a.m. Eastern time, we have the final GDP quarter on quarter. We also have the USD unemployment claims. So the GDP quarter on quarter is expected at 2.3%, an improvement from the previous 2.1%. A stronger GDP growth figure could boost the dollar and impact gold negatively. And unemployment claims is forecasted at 213,000, slightly higher than the previous 201,000. A rise in unemployment claims may raise concerns about the job market and economic health. So if both GDP and consumer confidence exceed expectations, it indicates a robust economy. This could strengthen the dollar because foreign investors may seek higher returns in the US, driving up demand for the currency. So a strong economic growth can contribute to inflation. When the economy expands rapidly, there's an increased demand for goods and services, potentially pushing prices higher. Therefore, a stronger dollar resulting from robust economic data could also influence inflationary pressures. An increase in unemployment claims suggests job market concerns and economic uncertainty. This might weaken the dollar because investors may seek safer assets elsewhere. So high unemployment could put downward pressure on wages and consumer spending, potentially slowing down inflation. In such cases, central banks might consider more accommodative monetary policies to stimulate economic activity and inflation. So Fed Chair Powell, he speaks on Thursday at 4 p.m. Eastern Time, and any statement from the Fed chair can significantly influence market sentiment, particularly regarding monetary policy. So the Federal Reserve Chair's remarks can significantly impact market sentiment. If Powell hints at future monetary policy changes, such as interest rate hikes or cuts, it can influence market expectations. So changes in monetary policy, such as interest rate adjustments, can directly affect inflation. Higher interest rates typically slow down borrowing and spending, potentially reducing inflation, and lower rates can stimulate economic activity and push inflation higher. So we have core PCE price index month on a Friday, 8:30 Eastern time. It's expected at 0.2%, unchanged from the previous figure. This is a key inflation indicator. Any surprises could impact both gold and dollar. If core PCE inflation deviates from expectations, it can surprise and move the markets. Higher than expected inflation might strengthen the dollar temporarily as investors anticipate tighter monetary policy to control inflation. Inflation data directly reflects the current state of price increases. Higher inflation can erode the purchasing power of a currency, potentially leading to a weaker dollar if the central bank takes measures to combat inflation, such as raising interest rates. So on Friday at 10 a.m. Eastern Time, we have UOM consumer sentiment. So forecasted at 67.7, the same as the previous reading. Consumer sentiment provides insights into consumer spending and the overall economic outlook. A stable consumer sentiment generally supports economic stability and market confidence. It can be a positive factor for the dollar as investors feel more secure in the economy. Consumer sentiment can influence consumer spending. Higher confidence may lead to increased consumer spending, potentially contributing to demand pull inflation. Conversely, if consumer sentiment drops sharply, it might indicate reduced spending and lower inflationary pressures. Let's head into some chart analysis. First, we've got the US dollar index. So for the US dollar index, either we start pushing above 106.65 for continuation longs, or we could get a pullback to 105.2, which corresponds with the pullback in gold to around 1936. But if price breaks 105, there is a higher probability of price pushing down further. And on gold, we could get a deeper pullback after last week's bears. We'll be watching 1930 and potentially 1936 for some high risk, high reward sells and continuation shorts from 1923 and 1920. If gold does push back up to around 1930 to 1936, this would correspond with Dixie pushing down to around 105.2. So I'll be watching these levels and staying alert and staying adaptive. Thanks for watching, everyone. Make sure you like, comment, subscribe, and follow us on Twitter, Instagram,